This is the first video of Chapter 3, which covers gross income, what is included in gross income, and what is in fact excluded from gross income. As they state, it says that many items, of course, are included in gross income. Your gross income is all items of income, and they are reported. The more common ones, as we saw in a prior chapter, are reported right on the face of the 1040. Lines 1A through 7, and then the less common ones are itemized on Schedule 1, the total of which, shown on line 10 of Schedule 1, flows over to the 1040. Now, I don't expect you to memorize line numbers or that type of thing, but just know that the more common ones are shown right on the face of the 1040, and the less common ones, which we'll talk about, are on Schedule 1. The Internal Revenue Code, or Congress, has defined gross income as not as what it is. It basically said it is income from wherever. Gross income includes all income. And rather than making a list of what's taxable, they said all income is taxable unless we say it's not. Therefore, income is gross income unless the Internal Revenue Code specifically excludes it, which was a pretty easy way out for them. They basically, if they're not sure if something's taxable or not, if we're not sure if something is taxable, unless we can find somewhere where it says that it is not taxable, it will be taxable. Okay, well, first we're going to talk about the theory and the timing of recognizing income. Now, for financial accounting, which is what we covered in 4A. For purposes of preparing financial statements, we recognize income when income is both realized and earned. Realization, textbook definition of that is the process of converting some item, some non-cash item or service, into a right to receive cash. So that's when it's realized. And then when it's earned, when we have performed all the duties and responsibilities that we need to do, when we're done and we basically are now entitled to it. Well, for tax purposes, it's a little bit different. It kind of follows that, but it's basically, for tax purposes, we only recognize income if 3 conditions are met. First, there must be an economic benefit. We have to be better off somehow. We have to have ended up with more cash or more property or less liability, something. We have to have benefited in some way. The transaction must have reached a conclusion. So what that means is that sometimes if you buy stock, say in IBM, you buy it for $100, and it starts to increase in value, goes to $150 and $175, $200 in value. That, of course, there is an economic benefit to that increase, but the transaction isn't done yet. I have not locked it in. That transaction won't be completed until I sell it. So that's why increases in value are not considered taxable, because they have not reached a conclusion yet. So if I have an item that has provided me with an economic benefit and it has reached a conclusion, it's locked in, and I can't find anywhere that says it's tax exempt, then that's what's taxable. The examples here are pretty good. It states here that in December of 2022, Raul agreed to repair a damaged roof and started work on that date. In January, he completed the job and received payment. This would be income in 2023. That's when he actually received the payment as well as earned it. It doesn't matter that he entered into the agreement in 2022. Now, most individuals, most of us, we use the cash basis of accounting. We recognize like our wages. We are in a cash basis taxpayers. So if we get paid on the 5th and the 20th of every month, in December, when we earn the last couple of weeks' wages in December, the last 2 weeks in December, but I don't get paid until January 5th, that is January's income. That income, even though it was earned in December of, say, 22, it is going to be on my W-2 for 23. We are cash basis taxpayers, so it doesn't matter when we earn it. It's when I actually receive it or constructively receive it. Constructive receipt means that the funds are made available to me or are within my control. So I can't tell my employer, oh no, don't pay me don't give me my check until January, so it's not taxable until January. No, when it becomes available, when I could have gone and picked it up, that is when it's constructively received, when there's no restriction on when I can get it. So income can be realized in any form, in property, cash, or services, even debt relief. It can be received indirectly. For example, if a lawyer agrees to give legal advice to a neighbor in exchange for the neighbor agreeing to paint their house, no money's changing hands here, but they are both, in fact, receiving an economic benefit of sorts, and they both have income. This one is Frederica owns an unincorporated cash business, architectural firm. She performs services for a client during December of 22. She completes the work in 22, so it's all earned, but she didn't get payment until the end of the year. Until even though she billed it, she didn't get her payment until 23. That's 23 income. For tax purposes, most of us are cash basis taxpayers. It's easier to track cash than the earnings cycle. Here's one where we received a benefit indirectly. Antonio provides golf lessons to Arturo worth $300, but Antonio owes Millie $300, so he says, nah, don't pay me, pay off my debt for me. Well, Arturo didn't receive the cash, but he received an economic benefit. He had a liability of his paid. Therefore, he has income in the year that debt is paid. So cash basis, we recognize income when we receive the cash or the service, regardless of when it was earned. We recognize it as income for tax purposes when it's received. There are some exceptions to this. They talk about here savings bonds, U.S. savings bonds. Don't see a lot of U.S. savings bonds, but generally the way savings bonds work is that taxpayers will buy them at a discount, maybe buy one for $10, hold on to it for 20 years, and then it'll be worth $50. Slowly it makes its way up. You can cash it in at any time, but the longer you hold it, the more it'll be worth. Now, cash basis taxpayers will not recognize any income until they in fact turn it in. So we may buy it for $10 and hold on to it for 20 years. When I turn it in the 20th year, that's when I have $40 of income because the transaction has reached a conclusion. But Congress recognized that when some individuals, if they have a lot of these, that may result in a lot of income being recognized in that last year and maybe throwing taxpayers into a higher tax bracket. So in this case, taxpayers can actually recognize the income annually as the value increases. They would actually see how much the value increased, what they could have turned it in for, and then recognize that increase in value, basically recognizing it on the accrual basis. And that's at the taxpayer's discretion. They're the ones that get to decide whether to do that or not. So there are some exceptions to the cash basis, but they're generally at the taxpayer's choice. Okay, we're going to talk about various types of income, the more common types of income, and maybe some exceptions to their taxability. Now, interest income. Interest income is what I receive for letting somebody else use my money. Most of us think about that as putting our money on deposit in a bank or a savings account, and we periodically, once a month, we get credited for that interest. That is taxable. Now, we will be reported that amount of interest on a Form 1099 INT for interest. Let me scoot down here. I think there's a copy of one. There it is. I think we saw this in a prior chapter too. It's got the bank's name and their ID number. It's got your name and ID number. And it says how much interest income you've earned. So we definitely want to include that on our return because the IRS is getting a copy of that 1099 as well. So they're going to be looking for it. Interest income is generally taxable. However, we talked just a little bit earlier about these savings bonds. They talk about it in a little bit more detail here. We can either wait until I cash it in and recognize the entire amount of income at that point, or I can elect to report the annual increase in the value as I go. Kind of takes the sting out of it as well. basically putting it on an accrual basis. I don't want to make these videos too long because I know your time is valuable, so I'm going to leave some of these examples for you to go through that just highlight what we've talked about. Now, there is some interest that is non-taxable. That is non-taxable by the federal government, and that is interest that we earn on bonds that we purchase from government entities, not from the federal government, but from entities below the federal government. So if you were to buy bonds, which are state bonds, state of California bonds, or county bonds, county of Fresno bonds, city of Fresno bonds, the Fresno Unified School District bonds, things like that, those are all government agencies below the federal government, state, county, city, school, municipalities. The interest income that I receive on those bonds, which is just a form of borrowing, is tax exempt. Those are called muni bonds, municipal bonds. That gives them a little incentive for allowing a lot of taxpayers like to invest in these municipal bonds so they don't have to pay tax on them. There is one exception to it, and it says that it will turn around and be taxable again. There's an exception to the exception if those state or local bonds were the proceeds of which were used for private activities, such as building a convention center or a stadium like our park out here, the Chick-Chansey Park, or things like that. If they're not for the public good, but for some sort of a for-profit endeavor funded by the municipality, then they will in turn be taxable again. We don't have to worry too much about that because when I receive the 1099 from the municipality, it will indicate whether it is taxable or non-taxable. They know what their purpose is and whether it will be taxable or not. So in investing in those, it wouldn't hurt for the taxpayer to make sure that they are in fact taxable. When we have, or not, in fact non-taxable, the interest income, there is a schedule, Schedule B. We haven't seen Schedule A yet, but Schedule B. Now that we're not talking about Schedules 1, 2, and 3, which is the supplemental schedules to the 1040. This is details on line items on the tax return. Schedule B deals with interest and dividends. Interest and dividends. We have to actually provide the detail of the interest that I earned if I have more than $1,500 of interest income, or if I receive seller finance mortgage interest, which means I sell a piece of property and I'm letting them make payments to me with interest. So there's some information to be disclosed there. Received any tax exempt interest, if I received any, and a few other things here, but generally it's if we received more than $1,500 of interest income. The IRS wants to know who did I receive it to and how much? Who did I receive it from and how much? So we would put it here, total it up, total up the amount, and then carry it over to the 1040. Let's see if I can find that 1040 real quick. Here we go. Here's the 1040. This is interest income. Notice that I have my taxable interest income, which is shown on line 2B here, and my non-taxable interest income, which is on 2A, and it does say attach Schedule B if required, and that's when it's required, is when I have any tax-exempt interest, or if the taxable amount is over $1,500. On Schedule B as well is not only interest, but dividend income. That's really the second form of investment income that investors look for. They either look for interest that on the funds they have deposited with institutions, or dividends on stocks that they've invested in, hoping to get some dividends back. Dividends are reported on the second half of the Schedule B here. If the amount is over $1,500, we need to report where those dividends came from on Schedule B. Let's talk about what those dividends are. We'll come back to the 1099 dividend here in a second. Now, dividends, as we discussed in 4A, are really just a distribution of profits by an organization. A corporation makes money, and it distributes some of those profits to its shareholders. Now, the nice thing is about dividends are if they are qualified dividends, they are generally taxed at capital gain rates, which we haven't talked about yet, but capital gain rates is a lower tax rate. So it's always nice if you have an item of income. It's always better to have it treated as a capital gain, so we don't pay as much tax on it. If the dividends are more than the profits of the corporation, then it starts dipping into liquidating the corporation. Then they are not dividends, but we're not going to get that far into it. We're going to assume that the dividends we receive are from earnings and profits, and it's just a distribution of profits. They are usually paid in the form of cash, but can be paid in the form of other property as well. It's very rare for it to be, but regardless of whether it's cash or property, the fair market value is going to be treated as a dividend. Stock dividends are distributions of additional company stock, the very same company giving more of its stock to its shareholders. Now, stock dividends really don't give the shareholders anything more than they had. If you own 10% of a company and they have a stock dividend, you're going to get 10% of that stock dividend, and you're still going to own 10% of the company. So Congress recognizes that that's really not a distribution of anything. You're not changing your ownership, so they are generally non-taxable, as well as stock splits. Stock dividends and stock splits are non-taxable to the shareholder. However, if they are not completely proportional dividends, stock dividends, then they will be taxable, such as if a shareholder is given the option to receive either stock or cash. Well, some will pick stock, some will pick cash. That's going to change the ownership proportion. Then it's taxable to everybody. The cash is taxable as well as the stock that was distributed is taxable. If it's disproportionate, some shareholders get it, some don't. You're not really supposed to do that, but if for some reason that happens, that changes the ownership, the structure of the corporation. So therefore, those would all be taxable. Distributions of preferred stock are taxable. And along with that, if some stockholders get preferred stock and some get common stock as a stock dividend, those are all taxable. It has to be a purely proportionate common stock dividend to be non-taxable. Mutual funds are they are investment vehicles where a lot of individuals will pool their money into one big fund, and it is managed by a professional advisor who buys and sells stocks for that fund, and then the earnings, both dividends and gains and losses from the transactions in those stocks within that pool, are then distributed back out to the members, the people who own the mutual fund. So if I invested in a mutual fund and as a result of that I got some dividends from that mutual fund because the mutual fund received dividends and gave me my share, well then that's taxable to me just as if I earn those dividends directly. So mutual funds is just an accelerated way of getting dividends that are managed by professional advisors. Now, we said earlier that qualified dividends, there are certain types of dividends, qualified dividends are taxed at lower rates, and that's very nice. So if I'm going to invest in a company and they're going to pay me dividends, then I would like for them to be qualified dividends so I can get those preferential treatment, the lower tax rates. Qualified dividends are from the earnings and profits of domestic corporations, U.S.-based corporations, or various foreign corporations that the United States has no problem with. For example, Volkswagen in Germany or Toyota in Japan, I think. Those are all qualified foreign corporations. These are all either U.S. corporations or our friends, corporations who are considered friends of the United States. Dividends from those organizations are taxed at lower rates. And here's the rate. It's based on filing status and taxable income of the taxpayer. This is hard to read, but it does. I will tell you that dividends will be taxed at either 0%, there'll be no tax on it, or 15%, or 20%. Those are the three capital gain rates. So, and as your income goes up, your marginal rate will go up, the way they've set this up is that if you are paying, say, if your marginal rate is 24%, but you had qualified dividends, we're only going to tax you 15% on those dividends. Or if your marginal rate is 37%, we're only going to tax you 20%. Or if your marginal rate is relatively low, it's only 15%, then we won't tax you at all on those dividends. An easier way to see this is to see it in a table. And I wish they would have put it in a table, but here's what the table would look like. I just taped it on my screen here. So here's what you can see is that generally here's your capital gain rates. Depending on your filing status, if your taxable income, say if you're single and your taxable income is from 0 up to 44,625, well, you're paying tax. You're probably in the 12 or 15% tax bracket. The rate applied to your qualified dividends is 0. For married filing separate, it's the same one. Head of household, it's up a little bit higher, and then married filing joint is twice that much. You can see here for single taxpayers, if your taxable income is over $492,000, well, your marginal rate is probably 37%. You're paying tax at 37%. So if we added more income, income to where you are currently, you'd pay 37% on it. But if it's qualified dividends, we're only going to tax you at 20%, only at 20%. So these rates are actually much lower than what they would be depending on where your taxable income is. So let's do an example of this. So I'm going to load a copy of this on Canvas as well, so you'll have it available to you. I think it's much easier to follow that than trying to dig it out of the paragraph here, out of that narrative. Let's look at this example that actually shows the computation of it. It says that we've got a single individual. He has taxable income of $110,000 before dividends. That's before any dividends. And if you look in the tax brackets in Schedule F, you'll see that he's in the 24% marginal tax bracket. So if we add another $1,000 to it, see, he had qualified dividends of $1,000. If we add another $1,000 to this, make his total taxable income $111,000, well, then he'd pay another $240 because that's what his marginal tax bracket is in. Oh, but wait, these are qualified dividends. For a single individual with taxable income of 110, let's see, single individual from 44 up to 492,000, well, he's only going to be taxed at 15% on those dividends. So we calculate the tax, the tax on, they walk through the rate here, the tax rate schedule, and they come up with the tax on the 110,000 is 19,800, and then I need to figure out the tax on just the 1,000 at 15% is 150, so his total tax will be $19,950. I think somewhere they say here that, here it is, that the dividend income is always added to the end. You calculate it at the end of the computation. So if a homework problem tells you, oh, he has taxable income including qualified dividends, well, back those dividends out. Get those out of there. Calculate the tax at the regular rates using either the tax rate schedule or the tax rate table if it's under 100,000. Calculate that tax, and then based on what your taxable income is, determine what rate, 0, 15, or 20%, you're going to tax the qualified dividends on. Calculate the tax on the qualified dividends at that lower rate and add them together. So I think that the homework problem does it that way. I think it says has taxable income including qualified dividends. So you need to carve those dividends out. Calculate the tax on the non-dividends and then the tax on the dividends. Add the two together. Let's see, I think we've covered the everything here. One thing I wanted to show was the 1099 dividend. Yeah, when you receive dividends, where did that go? Let's see. When you do receive dividends, there it is, sorry. You will get a 1099 reporting to you and to the IRS how much dividends you actually received. You don't have to determine if they're qualified. They were in box 1A, they show what was the total dividend, and box 1B, how much was qualified. Many times these are the very same number. Received money from Microsoft Inc., dividend $1,000, qualified $1,000. We know, oh, that's going to be taxed at a lower rate. So that's very nice. Now there are two computations in this chapter that are complex. They really do illustrate the complexity of tax law. Thank goodness we have computers that will assist us in doing this. The first one is the state and local tax refunds. State and local tax refunds. I'm going to set up an example. I think it'll be much easier to understand this if you understand what we're talking about in a state or state tax refund, where it came from, and then we'll talk about how we determine whether it's taxable or not. So I'm going to switch over to a piece of paper. Okay, so now here's the situation. I'm preparing my 2023 tax return, and it just so happens that in 2023, back here in April, when I filed my 2022 tax return, I actually received a state tax refund of $400, not federal. A federal refund is never taxable, never. But I received a state tax refund from the state of California. I got $400. Now, state taxes are generally deductible. So the question becomes, is this taxable to me? Is that taxable? So what we have to do is we have to determine, did I receive a benefit? Was I able to reduce my last year's taxes by deducting this $400? And if I was able to reduce these taxes, then yes, I have to take it back into income in 2023. This is called the tax benefit rule. Did I get a benefit by deducting my state taxes last year? So let's go back to last year now and see, where did this $400 come from? In 2022, when I look back at my return that I prepared for 2022, I had wages, and I actually had total withholdings of $1,500. That was withheld on my wages. I prepared my federal, we'll start with my state return. Now we'll start with federal. I prepared my federal return. I had gross income of $100,000. Now we talked about in the last chapter that from that we get to deduct either my standard deduction, and it was $12,950 back in 2022. I either get to deduct the standard deduction, no questions asked, I just take that amount and it's as simple as that. Or if I have itemized deductions, which means that I can take my state income tax, which was the $1,500, this $1,500 that I actually paid in through withholdings, I paid that $1,500, and then I put other here. We're going to cover this in chapter 5. But if I had contributions, mortgage interest, medical expenses, other types of things, whatever that amount came up to be, if this amount is larger, if it's larger, if this total comes up to say $15,000, well, then I'm going to take the $15,000 rather than the $12,950. If it only comes up to say $8,000, well, then I'm going to just take the $12,950. I get to subtract the larger of the two, either my standard deduction, or if I can show I paid more than this $12,950 of these various identified items, I can even subtract a larger amount. So I'm going to subtract off either this or this, one of the two, to arrive at taxable income, and that's what I'll pay tax on. Now, during the same year, I actually filed my state return. The total tax that my state return came up owing was $1,100, and this is just my example, just an example. I had withheld $1,500. Remember, I had withheld $1,500, so I got a $400 refund. That's where the refund came from. That's where it came from. I only owed $1,100 of tax when I filed the 2022 return, paid in $1,500, so I'm getting a $400 refund. Is that taxable? Is that taxable? And as it states in the textbook here, hold on just a second, I'm gonna come this way real quick. In blue there, the taxable amount is the lesser of three items. It cannot be more than the amount received. It cannot be more than the amount we attempted to deduct in our itemized deductions. And third, and probably harder to find, is it cannot be more than the amount by which my itemized deductions exceeded my standard deduction. What does that mean? Okay, well, here's the three numbers. Here's the three numbers. 1. Let me get a different color here. 1. We're looking for the lesser of the three. This is number 1. I cannot be taxed on any more than I received. So that's number 1. Number 2 is right here. How much did I actually try to deduct when I was adding up my itemized deductions? How much did I try to deduct there? Because I certainly wouldn't get any more of a benefit than $1,500. And then number 3 is the amount by which my itemized deductions exceeded my standard deduction. So I'm going to say, suppose that all my other items of income or deductions here added up to $11,700. So my total itemized deductions were $13,200. So which one did I actually deduct? I guess I should show this right here. That's what this is supposed to be. So which one did I actually deduct? Did I deduct the $12,950 or did I deduct the $13,200? In this case, wow, this number was bigger, so of course I'm going to deduct that. I'm going to subtract that because it's a larger amount. But just how much, this $1,500, if I didn't have any of that, what would I have deducted? Well, I would have only had the $11,700, so I would have taken the $12,950, right? Would have done that. But by virtue of the fact that I had $1,500, how much more did that $1,500 get me than I would have had otherwise? It's this versus this. Oh, it actually got me another $250. That's the amount by which my itemized deductions exceeded my standard deduction. That's the third number. So the amount that's taxable cannot be more than the refund itself, cannot be more than the amount I tried to deduct on my Schedule A, and cannot be more than the amount by which my itemized deductions exceeded my standard deduction. In this case, the amount of this $400 that would be taxable, the lesser of the three amounts is this. So step back for just a moment with me, and this $1,500 deduction actually got me another $250 more deduction than I would have gotten otherwise. So that's why what's taxable here would only be the $250. So a couple things to point out here to remember is that, number one, if you didn't get a state tax refund, nothing's taxable. It can't be more than your state refund. Number two, if you did not itemize, you took the standard deduction, well then your itemized deductions over your standard deduction was zero. So it's not going to be taxable. There's no way. The only way that a state refund can be taxable is if you actually got a refund and you itemized, and actually itemized. So that's why this is called the tax benefit rule. I'm getting some of this $1,500 that I tried to deduct back. It only got me another $250 deduction over and above what I would have. So that's why that's taxable. So those are the three amounts you're looking for. And the amount taxable is the lesser of the three. Let's look at the examples here. It's certainly, with this complex area, it certainly doesn't hurt to take a look at the two examples and get a little bit more practice with how this works. Okay, now remember the standard deduction back in 2022 was for a single individual was $12,950. That's what it says here, $12,950. So in this case, Natalia, who is a single, she reported itemized deductions of $14,900, which included $1,150 of state taxes paid. She got a $120 refund. So it does say she must include it all in income. And why is that? Well, it's because she got $120. That was the amount of the refund. So that's one. Two, she included $1,150 of state income taxes in her deductions in 2022. So that's the second number, $1,150. So far the lower of the two is $120. And then third, how much did her itemized deductions exceed the standard deduction? Well, it exceeded it here by about $2,000. So she certainly got a benefit of deducting $1,150. It actually reduced her taxable income last year by $1,150. So $120 is taxable. But how about if she only got a her itemized deductions were only $12,990. Same scenario, she got $120 back of her $1,150, but her $1,150, including that $1,150 of state taxes in her itemized deductions, only put her at $12,990. That only gave her $40 more than she would have normally had. So that $1,150 only reduced her taxable income $40. So only $40 of that refund will be taxable. It's the lesser of the three amounts. The lesser of the $120 refund, the $1,150 that she tried to deduct, and the $40 that her itemized deductions exceeded her standard deduction. If she didn't itemize, zero, right off the bat. State refunds are reported to recipients, so we want to take this into account too. It's right here, it's a box 2 on the 1099-G for government, state and local refunds. Thank goodness for computers. I think we'd probably forget about a lot of this, forget about these types of income if we didn't have computers tracking this for us. This is just one example of many examples where tax returns actually tie in. This year's tax return, I need last year's tax return to make sure things are being reported correctly. When we get a brand new client, they want to come in and they want us to prepare, say, their 2023 return. I ask for their 2022 return. And they may wonder why I need to know that. Well, this is one reason right here. I need to know if you got a state refund, and I'm going to have to calculate and see how much of it's taxable. Thank goodness for computers. I've said that a couple times already, and I'll probably say it 100 more times before we get through these videos. So, other types of income. Unemployment compensation. This is on Schedule 1. This is one of those types that are on it's not on the face of the 1040. See, is the state refund? Yeah, that's on Schedule 1 as well. Not everybody has a state refund. Unemployment compensation, it's taxable. Benefit, they are taxable. They are supposed to be a substitute for wages, and wages are taxable, so it's taxable. Really no way around it. Social Security benefits. I think I'm going to cut the video right here because this is the second item that's highly complex, and I really do want to it's probably going to take us a half an hour to get through Social Security benefits. And so once we get past this, and we've discussed this, then the rest of the chapter is kind of downhill. So I'm going to cut the first video off here, and we'll start video number 2 with Social Security benefits.